All right, everyone. As promised, here is kind of a review session for the second exam. I'm going to just start off very basic and just make sure everybody understands what to expect on Thursday. And then I'm going to quickly go over charitable donation deductions. Again, that's what we ended class with today, and it went kind of quick. And so I think it'd be helpful to give a more thorough explanation about that. And then I'm also going to talk about the last couple of topics from Chapter 6, which will be tested on Thursday's exam. And then I'll go over rather quickly the main points from the earlier chapters. Okay, as I'm doing this, I'm going to try to help you out a little bit. It's a lot of information to kind of get a handle on. So as I go through the information, I will point out areas that you do not need to worry about for the exam. Okay, so as I was going through my notes, I kind of identified a number of areas that I can just let you know it's not going to be on there, and that'll take hopefully a little bit of the stress off you in preparing for Thursday's exam. Okay, but starting off, important things to know. So just like the first exam, you can bring a crib sheet. The crib sheet has to be, it can only be one side of an 8.5 by 11 sheet of paper. It has to be handwritten. It has to be your own handwriting. I will collect it with your exam. There'll be a penalty if your crib sheet doesn't follow the guidelines. If it's two-sided or if it's typed, it has to be handwritten. Okay, but I just wanted to confirm to everyone that you can use a crib sheet again, similar to the first exam. I also wanted to make sure you're aware of the information that I'm providing so you don't have to waste space on your crib sheet with this information. Basically, I'm going to provide the sheet of paper I provided with the first exam that shows the tax tables, individual and corporate. It shows the standard deductions by filing status. It shows the extra standard deduction if that applies if a taxpayer is 65 or older and or the taxpayer is blind. You'll have those amounts. I'm going to provide the formulas for calculating taxable Social Security, so you don't need to worry about, squeezing in those formulas on your crib sheet. You'll get that information with the exam. I'll also provide, as I said during class, the tables for the student loan interest and tuition expense deductions. So those tables were kind of embedded in your class notes, and I'll go ahead and kind of copy and paste that information onto a packet of information that I'll give you with your exam. So that's the information that I'll provide. If there's a question about annuities, you'll be able to calculate the expected value of the annuity without the life expectancy table. Okay, so I didn't list that as something that I would provide, but please don't put that on your crib sheet because you won't need it. Okay, so in Chapter 5 there was that table based on the age you are when you start receiving the payments to calculate the expected value. You do not need to worry about that for the exam. Okay. So I just one word of caution about the crib sheet. I know it can be really, really helpful, but please have a good handle on the information before you come in, okay? I think that students that tend to do best put together that crib sheet. It's a great final review for them as they get ready for the exam, but they tend not to have to use it so much during the test. If you write very, very small and fill up every inch of the crib sheet, that's fine, you can do that, but you may run into time issues, okay? If you really don't know anything and for every single question you have to refer to the crib sheet, that could be very time consuming, and I would worry about whether or not you could finish the exam in an hour and 15 minutes if you're using it too heavily, okay? So just kind of a word of caution. So that's important things you need to know. As I said in class today, there's 11 multiple choice for 33 points, and then about 70% of the exam is going to be application problems. So just kind of an FYI, within the application problems, I will test dependency and filing status. Okay, so those questions are going to look pretty similar to what you did for the homework. So if you did the homework and you understand it, you should do well, and that's the format that you'll see on the exam again. So those types of questions, they're conceptual in nature, but those are going to be tested as kind of application problems, not multiple choice. A number of the multiple choice questions actually ask you to do a short calculation. So I think aside from filing status and dependency information, this test is pretty light on conceptual stuff. Okay, we did a lot of calculations, and that's where we're going to focus our attention on the exam. Okay, is calculation-based questions. Okay, So that's information for Thursday's exam. Tomorrow, again on Wednesday, I'll have office hours beginning at 9 and I'll be around until 2. So you can stop by anytime, 9 to 2, and I'll be around. And then if you can't come into office hours and you're studying late, I will commit to checking my email at 10 o'clock. I'll respond to anyone who's emailed me by 10, but after 10 o'clock, you're on your own, okay? And don't expect a response if you email me, at midnight, okay? So please plan accordingly, and certainly stop by. Don't be shy. Stop by tomorrow if you have last minute questions, okay? All right, so I wanted to follow up to Chapter 6. What we ended today's class with were charitable donation deductions. And so when you donate to a charity, you can donate cash to a charity. Cash is actually quite easy. Or you can donate property to a charity, okay? So when you make a donation to charity, there are really two things that you need to determine. The first thing you need to determine is the amount of your deduction. So or the maximum amount of your deduction. If it's cash, the amount that you can deduct is the value of the cash. So cash, the fair market value equals the basis. There's never a difference. It's just the face value of it. And that's the deduction that you can take for any cash donations. The AGI limitation for cash is 50%. Okay, so this is what we ended class with, and it went pretty quick. So I'll talk in detail again about what this AGI limitation means. But if you contribute cash, the amount of the donation is the value of the cash, or the amount of the cash, and the AGI limitation that applies to cash is 50%. So then we can go on to property. Property is a little bit more complicated. Again, you need to determine two things for property contributions: the amount of the deduction that you can take and the applicable AGI limitation. So there's three types of property that you can contribute to a charity. The first type of property would be capital gain property. Capital gain property is basically any property that if you sold it instead of donated it to a charity, if you sold it instead, it's capital gain property if the sale would generate capital gain income. So we're talking about investment assets and basically investment assets, specifically stocks and bonds, and maybe property like land and those types of investments. So those are typically what we think of when we think of capital gain property. The other thing that your book really likes to use as an example is artwork. So you might hold artwork for an investment. As long as you hold the artwork for more than a year and it is appreciated in value, then that would be capital gain property. Okay, so those are the three big buckets of capital gain property: stocks and bonds, land or real estate that you're holding for investment, and then artwork potentially. Okay, so if you have capital gain property, again, it's property you've held for more than a year, that's appreciated in value, and that would generate capital gain if you sold it. If you have this type of property and you donate it to a charity, the amount that you get to deduct related to that property is the fair market value of the property. Okay, so for this property, you'll have a fair market value, and you'll also have basis, what you purchased it for. The deduction you get to take for capital gain property is fair market value. This is a really nice benefit in the tax law, okay, because your fair market value might be much larger than your basis, and so this is a nice way to get a large deduction for a charitable donation. Okay, so capital gain property, the amount of the deduction is going to be the fair market value. That AGI limitation that applies is 30%, and again, in a second, I'll go into detail about what that means. The second type of property you might donate to a charity is non-qualifying capital gain property. So this is basically it's capital gain property that isn't aligned with the mission of the charity. So the biggest example that you'll see in your homework and potentially on the exam, something that would be non-qualifying capital gain property would be, again, artwork that you donate to the United Way or Big Brothers Big Sisters, and you know that this organization is not going to display the artwork. They're going to sell that artwork, get the cash, and use the cash for the charitable purpose of the organization. So if you have a piece of artwork, it's appreciated in value, it's worth more than what you bought it for, and you donate it to an organization that's just going to turn around and sell it, then your deduction is going to be limited to the basis of that property. Okay, you would not want to do that. That would be kind of poor tax planning, in my opinion. If you're going to donate capital gain property, you want to make sure you get the fair market value deduction for it. Okay, so that's something to think about. Something else that where this might become an issue, and probably not going to be an issue, but let's say you donate a car. So there's a lot of charitable organizations that will accept donations of cars or boats. Now, these assets tend to depreciate in value. It's unlikely that you have a car that's worth more than when you bought it. But if you do, and you donate it to a charity, and the charity's just going to turn around and sell it, then that would also be an example of non-qualifying capital gain property. Okay, if what you're donating is property unrelated to the mission of the charity, then your deduction, instead of being a fair market value deduction, your deduction is going to be limited to your basis. And we'll look at an example in a second of what that means. The AGI limitation that applies to non-qualifying capital gain property is a 50% limitation. Okay, so potentially you can deduct more in a given year, but the value of your deduction is going to be less if it's capital gain property because you're limited to the basis. The final type of property that you can contribute would be ordinary income property. So what is ordinary income property? It's any property that, if sold, would not generate long-term capital gain income. So types of income that are ordinary income property would be assets that you held for less than a year. Remember, in order for it to be long-term capital gain, you need to own it for at least a year, 365 days. So if you donate something that you've held for less than that amount of time, then it's ordinary income property. Okay, so anything that you've owned for less than a year. Inventory would be ordinary income property. If you donate some of your inventory to a charity, that's ordinary income property. And then finally, any asset that you own where the fair market value is less than your basis. So this would be stock that has that's devalued since you purchased it. You purchased stock 5 years ago for $10,000. Today it's only worth $2,000. Okay, so it's declined in value. Instead of selling it and generating the capital loss, you're going to go ahead and donate it to Big Brothers Big Sisters. When you donate that stock to Big Brothers Big Sisters, the amount of the donation that you can deduct is going to be the lesser of the fair market value or your basis. So in that instance, it would be the basis of the stock that you contributed. Okay, so if it's ordinary income property, again, inventory, anything you held for less than a year, and capital gain property that's worth where the fair market value is less than the adjusted basis, then your deduction is limited to the lesser of the fair market value or the property's basis. And the AGI limitation for this type of property is 50%. And again, in a second, we'll talk about what that means. So I'm just noticing a typo, so that it should be a apostrophe S, right? But I did this very quickly, so please forgive any grammatical errors. But this is a deal with property. You need to determine what type of property it is, capital gain, non-qualifying, or ordinary income. And when you identify which type of property it is, it'll tell you how much deduction can you take. Okay, it's either going to be fair market value or the basis, depending on what type of property it is. And it will also tell you what the AGI limitation is. Okay, so it's important for every donation you determine what type of property is it, and that will help you along with the rest of your calculation. Okay, so this 30 and 50% AGI limitation, what does this mean? So a taxpayer's overall charitable donation is limited. Okay, so there's a maximum amount that a taxpayer can deduct as an itemized deduction, and that maximum amount depends on the type of property that you contributed. So again, back here it tells us what kind of property each one of these items are, 50% or 30%. So cash, non-qualifying capital gain property, and ordinary income property, these three types of donations are subject to a 50% AGI limitation. So basically you add up the value of all of these donations, and if the total amount of all of these donations is less than 50% of the taxpayer's AGI, the taxpayer can deduct 100% of the donations. If you add up all of these 50% donations and the total is more than 50% of the taxpayer's AGI, then the maximum amount that the taxpayer can deduct is 50% of AGI. Okay, so that's what that means. The AGI limitation is putting a ceiling on how much a taxpayer can deduct in a given year. So let's say you're really, really charitable. Okay, you wrote a book, and so you're getting royalty income from the book that you wrote, but you've dedicated yourself to living a life of poverty and giving all of the proceeds that you've earned from your book to a qualified charity. Okay, so let's say your income is $100,000, and this is income that you've generated from royalty or from your book sales. Okay, so you've generated $100,000. You are going to donate $90,000 of this to a qualified charity, and you're going to survive on just the $10,000. Okay, because you've dedicated yourself to charitable purposes. So your AGI is $100,000. You donate $90,000 of cash to a qualified charity. The cash is subject to a 50% limitation. 50% of your AGI is $50,000. So what this means is when you file your tax return and you report itemized deductions, the maximum amount that you can deduct for charitable donations is going to be capped at $50,000. Of the $90,000 you actually contributed, you can only deduct $50,000. The additional $40,000 you can carry forward and deduct it in a subsequent year. Okay, so you don't lose the benefit, you carry it forward, and hopefully you can deduct it in the next couple of years. Okay, but that's what those AGI limitations mean. It sets a maximum amount that a taxpayer can deduct, and the limitation is based on the type of property that's being donated. Okay, so the amount that the taxpayer can deduct is limited to a ceiling, and the ceiling depends on the type of property. It also depends on the type of charity receiving the property. So your textbook talks about really 3 types of charities. Public charities, that's going to be like the United Way, Big Brothers Big Sisters, those types of charities. You can also have an operating foundation. And then the third type of organization that your textbook talks about is a non-operating foundation. For the exam, do not worry about non-operating foundations. So a non-operating foundation would be a foundation that raises money, but then gives that money away to other foundations. And so I think the example that your textbook provides is like the Bill and Melinda Gates Foundation. So their foundation takes contributions from people, but then what that foundation does is it gives money to other charitable organizations. So it'll give some money to organizations looking at cancer research and some organizations that are looking at improving education. So a non-operating foundation doesn't actually engage in any charitable work itself. It collects money and then divvies up the money that it collects to other charitable organizations. That's a non-operating foundation. There's more strict limitations for non-operating foundations, but for this exam, don't worry about it. Okay, for this exam, we'll focus on public charities and private operating foundations. And if you're given information on the exam, if you're given a list of donations that a taxpayer has made, you can assume that all of the donations, all of the charities that are listed, you can assume that they're either public charities or private operating foundations. Okay, so don't even worry about non-operating foundations. So hopefully that takes a little bit of stress off if you're looking through the class notes. Okay, so what are the limitations for public charities and private operating foundations? Again, we're subject to these 50% AGI limitation and a 30% AGI limitation. Again, cash, non-qualifying property, and ordinary income property are limited to 50% of AGI, and capital gain property is limited to 30% of AGI. Again, excess donations, you can carry them forward. You can carry them forward for 5 years. If you don't use them up after 5 years, then you lose the benefit. All right, so there are some ordering rules. So let's say you make some 50% donations and you also make some donations that are subject to the 30% limitation, and you need to figure out how much can you deduct. The first thing you're going to do is maximize your donations subject to the 50% limitation. So the first thing you're going to do is determine the limit for your 50% contributions. It's just 50% times your AGI. As long as your 50% donations are below this amount, you can fully deduct them. Okay. After you determine the 50% limitation, then you look at the 30% limitation. So to figure out how much you can deduct for donations subject to the 30% limitation, the amount that you can deduct is going to be the lesser of 30% of your AGI or 50% of your AGI minus the donations that are subject to the 50% limitation. Okay, and in a second we'll go over an example and hopefully it becomes a little bit more clear. Sometimes it's hard to just explain these concepts. It's easier if we have numbers to work with. But these are what the rules are. First, maximize your 50% contributions. Then you look at how much of your 30% contributions you can deduct. The amount that you can deduct is going to be the lesser of 30% of AGI or what's left over of your 50% limitation. Okay, and we'll look at an example. And then finally, you can apply limits to 20% contributions. That 20% contribution applies to non-operating foundations. So don't worry about it for the exam. Okay, I just put it on there just for FYI. If you ever use this information to go back and start studying for the CPA exam, this is something that you might need to worry about for the exam or something you might want to just review before you go take that portion of the exam. But to the extent you have donations that are subject to a 20% limit. And again, the only reason it would be subject to a 20% limit is if you're making contributions to a non-operating foundation, which will not be on the exam. But if that's when you would have these 20% contributions. So first you would maximize the amount you can deduct for 50% donations, then 30% donations, and then you look at the 20% donations. But these are the rules, and when we talk about the rules for 50 and 30% donations, then I think you could go back and figure out how to apply the limitation for 20% too. It follows similar rules. Okay, but this is how we're going to calculate the amount of the deduction. So let's look at the example. This is the example that's in your class notes. So we have a taxpayer, and the taxpayer made 4 charitable donations this year. One to a medical center of stock, donated a painting to a museum, donated food and clothing directly to a needy family, and cash to the United Way. So if you're given an example like this or a problem like this in the homework or on the exam, I'm going to try to break it down into a step-by-step process that will make it easier to deal with all this information. So I think a good way to attack it, the first step is determine the deductible amount of each donation. Okay, so look at each individual donation and figure out what is my maximum deduction for each of these. Again, the amount of the deduction depends on what type of property is being donated. Okay, so let's look at all of these. So the first donation is IBM stock. And so this medical center, we can assume that this is a qualifying organization and that it is not a non-operating foundation, okay, because that will not be on the exam. So we can assume this is a qualifying organization. We've donated stock. Our basis in the stock is $5,000. The fair market value is $22,000. I think that the example says that you can assume that the taxpayer has owned this stock for 5 years. So it's long-term property. So if the taxpayer were to sell this IBM stock instead of donate it to the medical center, the taxpayer would have generated long-term capital gain. The fair market value of the stock is more than what he purchased it for or she purchased it for. The stock was owned for more than a year, so this would be capital gain property. Because it's capital gain property, the amount of the donation is the fair market value of the property. So the maximum amount of the donation we can take for the IBM stock is $22,000. The next donation is a painting to a museum. The taxpayer purchased a painting for $5,000. Today it's only worth $3,000. So this is not capital gain property. Okay, it is not capital gain property because if we sold this asset instead of donating it, we would realize a loss. Capital gain property is only property that if you sold it, you would realize a long-term gain. Okay. Because if we sold this, we would generate a loss. It is not capital gain property. It's actually ordinary income property. So ordinary income property includes all property that has been devalued or that's worth less today than what it was when we bought it. Okay, so the museum is ordinary income property. The amount that you can deduct for ordinary income property is the lesser of your basis or the fair market value. The lesser of these two numbers for the painting is $3,000, and so this becomes the amount of the deduction we can take for the painting. The next is the needy family. We talked about this in class. If you give money or property directly to someone in need, that person is not a qualifying charity, and so you can take no deduction for these direct donations to people. If you wanted a deduction, you'd have to donate this instead to like the Salvation Army, okay? And the needy family would have to go to the Salvation Army and receive the food and clothing from that organization, okay? So the way the problem's written now, this is non-deductible, okay? Because the donee is a person and not an organization. But let's just, for sake of discussion, let's say that this is a Salvation Army instead of a needy family. So you've donated food and clothing to the Salvation Army. You purchase this stuff for $400. The fair market value is $250. If you donated it to the Salvation Army, this would become ordinary income property, okay? Again, it's ordinary income because the fair market value is less than the basis, less than what you paid for it, and the amount of your deduction would be the lesser of the basis or the fair market value. So the amount of the deduction that you would be able to claim on your return if you made this to the Salvation Army would be $250, and it would be subject to the 50% AGI limitation. Okay, so you'll actually see this one, you'll see this one a lot, where people are donating kind of gently used goods to an organization like the Salvation Army, okay? If you have a client that does that, the thing that you need to worry about is making sure that they're not kind of exaggerating the value of what they're donating. So you can go online. I think TurboTax has something. The IRS might actually have kind of a guideline for valuing your donated used goods, and they'll kind of give you a threshold for what they think it's worth. Basically, you should only deduct what you could realistically expect to sell it for if you sold it at a garage sale, okay? So typically your deduction is going to be significantly less than what you bought it for, okay? But that's that item. So for this scenario, because it's direct to people, this is non-deductible. And finally, we have a donation of cash to the United Way. Cash, the basis is always going to equal the fair market value, and cash is a 50% deduction, okay? So again, the first step is figuring out how much is the maximum deduction for each of these. Again, the stock is $22,000, the painting is $3,000, the needy family is $0, non-deductible, and the cash is $8,000, okay? The next thing you want to determine is the amount of the AGI limitation, and I kind of built this into the discussion to what I just said, but the IBM property is capital gain property subject to a 30% limit, the painting ordinary income subject to a 50% limit, the food and clothing non-deductible, and cash is always subject to a 50% limit, okay? So then we have to figure out how much can we deduct. So we've determined the amount of the deduction and the AGI threshold, and so now we have to actually calculate the amount of the deduction. So first, let's assume that the taxpayer's AGI is $100,000. So first we want to figure out how much they can deduct of their 50% donations. So we're going to start with our 50% property. We're going to maximize this deduction first. So our 50% property in this scenario includes the $8,000 of cash and the $3,000 for the painting. So our total 50% donations equal $11,000. The 50% limit is just 50% of our AGI. So the maximum amount that we could deduct for 50% donations is $50,000. Our actual donations are less than the limit, so we can deduct all of our 50% donations. Okay, so we'd be able to deduct all $11,000 of these donations because we're under this $50,000 ceiling. Okay, so once we know how much we can deduct for our 50% property, we have to figure out how much we can deduct of our 30% property. So again, the deduction that we can take for our 30% property is going to be the lesser of two numbers. The lesser of 30% of our AGI, so in this example, 30% of our AGI is $30,000, or 50% of our AGI minus our 50% donations. Okay, so in this example, 50% of our AGI is $50,000. The amount that we're going to deduct for our 50% property is $11,000. That's what we just determined. So this amount, our 50% limit minus our 50% donations, is going to be $39,000. We want to take the lesser of these two amounts, the lesser of 30 or 39,000 is 30,000. So this 30,000 becomes the maximum amount that we could deduct for our 30% property. Okay, so that's the maximum. We only have one item that's considered 30% property, and that's the IBM stock. Okay, that's capital gain property, and the stock is our only capital gain property. The maximum deduction that we could take for the stock is 22,000. The limitation based on our AGI is 30,000. So our actual donation is less than the limitation. So we can deduct our entire fair market value for the IBM stock. Because our actual maximum deduction is less than the 30% limitation, we can deduct the full 22,000. Okay? So this taxpayer in this situation, if the taxpayer's AGI is $100,000, the taxpayer can deduct $11,000 of 50% donations and $22,000 for his 30% donations, for a total itemized deduction of $33,000. Okay, so that's what would show up on this taxpayer's Schedule A under charitable donations, $33,000. Okay. So scenario B in this problem says, what if the museum told Calvin that it plans to sell the painting instead of displaying the painting? So for this problem, it doesn't matter, right? Because currently the painting is ordinary income property because the fair market value is less than the basis. So currently the amount that we're able to deduct is the lesser of those two amounts, or $3,000. That would be the same deduction we could take if the museum was going to go ahead and sell the painting right away. Okay, so in this scenario, it doesn't matter if the museum holds the painting and displays it or if it sells it right away. We're still limited to a $3,000 deduction, and under either scenario, the donation is going to be a 50% donation. Okay. But let's look at kind of think about another scenario real quick. It would matter. So under the current scenario, it doesn't matter. When would it matter? If the museum held the property or sold the property. It would matter if the painting's fair market value was more than the basis. Okay, so let's say that the painting's fair market value is $10,000 instead of $3,000. Okay, so the fair market value is now $10,000. The basis of the painting is $5,000. Under this scenario, the painting is capital gain property. Okay, it could be capital gain property because the fair market value is more than the basis. So under this scenario, if the museum is going to display the painting, if the donation is in line with the charitable mission of the organization, then it's capital gain property, and the deduction that the taxpayer could take would be a $10,000 donation or deduction. The taxpayer would be allowed to deduct the fair market value of the property because now it's capital gain property. Okay, the fair market value deduction would be subject to the 30% AGI limitation. Okay, under this scenario, again, it matters if the museum is going to display the painting or if the museum is going to sell the painting. If instead of displaying the painting, the museum tells the taxpayer, hey, if you donate this, we're going to turn right around and sell it because it's not the type of painting that we'd like to display in our museum. If the taxpayer knows that the museum is going to turn around and sell it right away, then this property becomes non-qualifying property. It becomes property that is not in line with the mission of the museum. It is no longer capital gain property. It is now non-qualifying property. The deduction for non-qualifying property is limited to the basis in the property. So now instead of a $10,000 deduction, the taxpayer only gets a $5,000 deduction, and the deduction is now subject to the 50% limitation for non-qualifying property. Okay, so if you have a painting with a fair market value in excess of the basis, it matters whether the organization intends to display the painting or sell the painting. It matters if the donation is in line with the charitable mission or not. It's going to impact the amount that you can deduct. It's also going to impact the type of limitation that you're going to apply to the donation. Okay, and we'll actually look at that in a second. So the next scenario for this problem is what if the taxpayer's AGI is $50,000 instead of $100,000? So we're reducing the taxpayer's AGI. We're going to attack it the same way. We're going to start with the 50% property and maximize our deductions for our 50% donations. Again, in this scenario, our 50% donations is the cash and the painting. So the total amount of our 50% donations are $11,000. If we take 50% of our AGI, we get $25,000. So again, we can deduct the entire $11,000 donation of 50% property because our actual donation is less than the 50% limitation. Okay, so in this scenario, again, we can deduct all $11,000. Okay, but if our AGI is $50,000, it will have an impact on how much we can deduct of our 30% property. Okay, our 30% property is that IBM stock. So if our AGI is $50,000, the limitation for our 30% property becomes the lesser of 30% of our AGI. In this example, 30% of our AGI becomes $15,000, 30% times $50,000. So our limitation is the lesser of $15,000, or our 50% limit minus our 50% donations. Again, our 50% AGI limit is $25,000, 50% of our AGI. Our 50% donations are $11,000. That's what we just calculated on this slide. Okay, we can deduct all of those. So if we take our 50% limit minus our 50% donations, this amount becomes $14,000. Remember, the maximum amount that we can deduct is the lesser of these two numbers, the lesser of $15,000 or $14,000. So in this scenario, the amount that we can deduct is $14,000. That's the maximum we can deduct. Okay. So our 30% donation is stock that's worth $22,000. So the maximum amount that we could deduct is $22,000 for this specific stock, but the 30% limitation is going to limit our current deduction to $14,000. So of the $22,000 donation, the amount that we can deduct this year is only $14,000. The excess $8,000 that we can't deduct this year is what we have to carry over. We can carry it over to 5 years and hopefully be able to deduct it over the next 5 years. Okay, we're not going to worry about the carryover for the exam. Don't worry about that. Just worry about how much you can deduct currently. Okay, so this taxpayer can deduct $11,000 in 50% donations and $14,000 of his 30% donation. So his total itemized deduction for charitable donations, $25,000. That's his maximum deduction, and he has an $8,000 carryover into the next year. Okay. And again, that carryover is because his 30% donation exceeds his 30% ceiling limitation. Okay. All right. So the last scenario here, we'll just work through what happens if the painting becomes capital gain property. So if you look up here at the table, we changed the fair market value of the painting from $3,000 to $10,000. Now the museum is capital gain property. And subject to the 30% limitation, so we can quickly run through the calculation. We're going to go back to assuming our AGI is $100,000. Now we have one 50% donation, cash of $8,000, and we have two 30% donations, stock and painting, with a fair market value of $32,000. Okay, so again, we're going to start with our 50% property. We want to maximize this deduction first. The total amount of our 50% property is $8,000. Our 50% AGI limitation is $50,000. That's the most we can deduct for our 50% donations. Our actual donation is less than that, so the amount that we're able to deduct is the full $8,000. Okay, we're not limited based on 50% of our AGI. We can deduct the total amount of our cash. So now we have to look at our 30% property. Again, our 30% property limitation is going to be the lesser of 30% of our AGI. 30% of our AGI in this situation is $30,000, or our 50% limitation minus our 50% donations. Our 50% of our AGI is $50,000. The amount that we deducted for our 50% donations is $8,000. So the amount that's left is $42,000. Okay, so we're taking the lesser of $30,000 or $42,000. The lesser is $30,000. This becomes the maximum deduction for our 30% property. This is the most we can deduct this year for our capital gain property. Okay, so the maximum we can deduct is 30. Our actual donations are 32, so we can deduct 30, and the extra $2,000 becomes a carryover, and the taxpayer's total charitable donation is the $8,000 50% property plus $30,000 of the 30% property for a total donation of $38,000. Okay, so that is how you calculate the deduction for charitable donations. Okay, so I'm hoping that this was helpful. Okay, I'm hoping, really detailed walking through it is helpful. There's an example, two examples actually in your homework. You should definitely go over those examples as well. So again, a very detailed explanation for the homework assignment is posted right now on Blackboard, so you can access that information and study the solution. Okay, any questions, stop by tomorrow. Don't guess on Thursday. Okay, come in Thursday knowing exactly what to do so you can ace this exam. Okay, and if you can't do it by yourself, come into office hours and I'm happy to help. All right, so the next type of itemized deduction is casualty and theft losses on personal assets. And so this is directly from your textbook: losses arising from a sudden, unexpected, or unusual event, such as a fire, storm, or shipwreck, or if something is stolen from you. You can take a deduction for that. Okay, the deduction is going to be an itemized deduction, and it's going to be limited. How we limit our casualty and theft losses, and again, so it's all in case law. Okay, you have to go to case law to go to the courts to determine if your loss qualifies as sudden, unexpected, or unusual. Okay, so there's a lot of case law that can tell you what to do with a specific loss, because it's a little ambiguous reading the Internal Revenue Code. Okay, but once you've determined that you can actually deduct the loss, the amount of the loss is going to be limited. So the first thing that you need to do to calculate the amount of the loss deduction, the amount of the itemized deduction for the loss, the first thing you need to consider is you can only deduct unreimbursed losses. So if something's stolen from you but you have renter's insurance and your insurance policy pays you the value of what was stolen, then you don't get to take any loss because you've been reimbursed. So only unreimbursed losses are deductible. The amount of the loss that you can deduct is going to be limited to the lesser of the decline in property value because of the casualty, or the taxpayer's basis if the property is stolen or damaged. So the decline in property value is going to be, if there's a hurricane and you've have substantial damage to your house, okay, then your house is not valued at zero, and the amount of your loss is going to be the lesser of the amount of the damage that was done to your house or your basis in the house. Okay, if something is stolen from you, then the decline in property value would be the fair market value, right? The value of what's stolen, and in that situation, the amount of the loss that you can deduct is going to be the lesser of the fair market value or your basis in the property. Okay, so you need to kind of look at that rule to figure out how much you can deduct: the decline in your property value or your basis in the property, whichever is less. So once you determine these amounts, your casualty and theft losses are actually subject to two separate limitations. So the first limitation is, first you have to deduct both losses. You have to reduce both losses by $100. So this is just going to get rid of a lot of like little damages or little thefts. Okay, you lose something small, and if it's worth less than $100, then you don't get a tax break for that. Okay, so that $100 limit is trying to get rid of a lot of tiny little things that taxpayers would try to deduct if there wasn't that limitation. So you take all of your losses. First thing you do is reduce each by 100. And then once you reduce each by 100, then you add all of your losses together and you come up with a total amount. And then that total amount is only deductible to the extent it exceeds 10% of your AGI. Okay, so you take that total amount, you subtract 10% of your AGI, and only the remaining amount is deductible in your tax return. So let's look at an example. We have Tim. He's had a bad year. In January, there was a freak storm and it damaged his sailboat. And in July, his motorcycle was stolen. So Tim originally paid $27,000 for the boat. That would be his adjusted basis in the boat. But he was able to repair the damage to the boat for $6,200. So that $6,200 is going to be the decline in the property value. That's what he had to pay to get the boat back to good condition. So for the boat, the deduction is limited to the lesser of $6,200, the decline in the property value, or the taxpayer's basis, which is 27,000. So the amount of the loss for the boat is going to be the 6,200, the lesser of those two amounts. Then Tim, also his motorcycle was stolen. He paid $15,500 for the motorcycle. That's his basis. The fair market value of the motorcycle was $17,000 before it was stolen. So how much loss can he deduct potentially for the motorcycle? It's going to be the lesser of the decline in property value while it was stolen. So the decline is the full $17,000 that it was worth. But we have to compare that to his basis. His basis was $15,500. His loss is the lesser of those two amounts, or $15,500. Okay, so the amount we're dealing with for the boat is $6,200. The amount we're dealing with for the motorcycle is $15,500. And sorry, this slide is just kind of explaining that again. And so again, what we're dealing with for the boat is $6,200. Now the boat was insured, and the insurance company paid him $1,000, or covered $1,000 of the cost. This is a reimbursement. Remember, you can only deduct unreimbursed losses or unreimbursed expenses, and so the amount for the boat becomes $5,200 after we account for the insurance reimbursement. The motorcycle was not insured, and so again, the amount that we're dealing with the motorcycle is $15,500, which is his basis, which is less than the fair market value. So that's where that number comes from. So again, two limitations. The first limitation is that we have to reduce both losses by $100. So with the boat, after we account for the reimbursement, the amount of the loss is $5,200. We have to reduce that by $100, and that loss now becomes $5,100. The deduction for the motorcycle, potentially $15,500, but again, we have to reduce each separate instance of casualty or theft by $100. So we have to reduce the motorcycle loss by $100 too. So the motorcycle loss becomes $15,400. So that's, once we determine the amount of the potential loss deduction, we have to reduce it by $100. So the boat is now $5,100. The motorcycle is now $15,400. After we've done that, we add everything together. Okay. So the total amount of the loss would be $20,500. That's $5,100 for the boat plus $15,400 for the motorcycle, a total loss of $20,500. And then again, the amount that we can deduct is only the amount that exceeds 10% of our AGI. So we subtract 10% of our AGI from this number. If Tim's AGI was $50,000, then 10% of his AGI is $5,000. We have to subtract 10% of his AGI, or $5,000, from the total amount of his loss, and the amount that Tim can deduct on his tax return is $15,500. Okay, so this is reducing the loss by insurance reimbursements, reducing each loss by $100, and then this kind of overall limitation, reducing this total amount after those reductions by 10% of AGI to get the amount of the deduction. And then this slide, the next example is, well, what if Tim's AGI was $150,000 instead of $50,000? So we're going to calculate the amount of the casualty loss in the same way. We're going to get down here, and the amount of the loss is still $20,500. We have to reduce this loss by 10% of our AGI. Now 10% of our AGI is $15,000 because our AGI is larger, and so Tim's deductible loss becomes $5,500. Okay. So that's casualty and theft losses. Oh, the final scenario is, how would your answer change if Tim received $65,000 in municipal bonds? It won't change, right? Because municipal bonds aren't taxable. Tim's AGI will not change, and so his limitation will not change. So nothing changes if he has muni interest of $65,000. Okay, so we're almost there. The next type of itemized deductions that you can deduct are miscellaneous deductions that are subject to a 2% AGI limitation. These deductions are employee business expenses. We already talked about these when we talked about overall business expenses. So the types of expenses are going to be subject to an overall 2% limitation are going to be dues, uniforms, union dues, CPE, publications. Some new ones, job hunting, if it's not your first job. the cost of education if it doesn't qualify you for a new job. So law school wouldn't count. An MBA might count. It just would depend on your personal situation. Potentially travel and transportation costs if they're unreimbursed, except that commuting costs are never deductible. So mileage to and from work every day, or your train ticket to and from work every day, you don't get to deduct that cost as an itemized deduction. Okay. You want, if your company is reimbursing you for some of your costs, you want your company to have an accountable plan. So if your company has an accountable plan and provides you with a reimbursement, then you don't have to include anything in income. If your company doesn't have an accountable plan and is providing reimbursement, you have to include the amount of the reimbursement as income, and then take the deductions that are going to be subject to this 2% limitation. So you want your company to have an accountable plan. The next type of deductions that's subject to the 2% limitation are investment expenses. So these would be, advisory fees, safe deposit box. If you subscribe to investment-related publications, these are all investment-related expenses. You can deduct them as an itemized deduction, but only to the extent that they exceed 2% of your AGI. The last type of these types of deductions are tax preparation fees. You can deduct them, but they're subject to a 2% limitation, and hobby losses. So we've already talked about hobby losses. If you have an activity and it's deemed a hobby, you can deduct your losses, but the losses are limited to your income. And then if you wanted to deduct them, they're going to be subject to this 2% AGI limitation. Okay? So if your hobby income is $5,000, your deductions are $10,000, the most you can deduct is $5,000. Your expenses are limited to your income, so the most you can deduct is $5,000, and then you have to apply this 2% limitation. Okay, so if you have an overall hobby loss, the impact is going to be a net positive impact on your taxable income. The income is always included in gross income. You have to include that in gross income, and your deductions are going to be limited. They have to be itemized, and only to the extent that they exceed 2% of your AGI can you deduct them. Okay, but these are the other types of deductions that are subject to the 2% limitation: tax prep fees and hobby losses. So basically, if you have information about these types of expenses, you just add them all up and you get a total number, and then you take that total number and you subtract 2% of your AGI, and anything left over is what you're able to deduct as an itemized deduction. So a quick example, we have Baker, and he has some expenses. He paid $775 for tax preparation. That's deductible as a miscellaneous expense subject to the 2% limitation. He has $375 of employee expenses, of which $60 was reimbursed. He also paid $100 for investment advice. So we need to calculate how much Baker can deduct. If his AGI is $50,000, again, he's able to deduct any unreimbursed expenses. So $775 for tax prep, $315 for his business expenses. It's the total expense minus his reimbursement because his company had an accountable plan, and $100 for his investment advice. So his total expenses $1,190. 2% of his AGI is $1,000, 2% of $50,000. So the amount that Baker can deduct in this scenario is only $190. Okay, not a big benefit for him on his tax return. Okay, because of the 2% floor. Again, add everything that's deductible together, subtract 2% of your AGI to come up with the amount of your itemized deduction. If Baker's AGI was $100,000 instead of $50,000, then he would get no deduction. Okay, his total expenses would be the same, but now 2% of his AGI would be $2,000, leaving him with no deduction. Okay, so some deductions are not subject to the 2% floor. So the two very specific types of deductions not subject to the 2% limitation are gambling losses, but gambling losses are always limited to your winnings. Okay, so you can only deduct losses if you have winnings. And then the second type are casualty and theft losses on investment property. Don't worry about that one too much. Okay, you should generally know how to deal with gambling losses though. So one more example, Simon lost $5,000 gambling this year in Vegas. In addition, he paid $2,000 to his broker for managing his portfolio. He paid $1,500 to his accountant to prepare his tax return. He paid $2,500 in commuting expenses, and we need to figure out how much can Simon deduct as an itemized deduction. So just going through each of the deductions, the first we have the gambling loss. He can't deduct any of it because he has no income. If his income is 0 and his loss is 5,000, he deducts nothing. Okay? If his income was 3,000 and his loss was 5,000, then he could deduct 3,000. Okay? We can only deduct losses to the extent we have income. The $2,000 he paid to his broker would be a deduction subject to the 2% limitation. His tax prep fees would be a deduction subject to the 2% limitation, and his commuting costs are non-deductible. Okay, commuting costs are never deductible. So how much can he deduct? 0 for gambling, 0 for commuting expenses. The other 2 expenses are subject to the 2% limitation. The total amount of those expenses are $3,500. If his AGI is $40,000, 2% of $40,000 is $800. So the amount he could deduct is $2,700. If his AGI was $200,000 instead of $40,000, then his deduction becomes 0. His total expenses would still be $3,500, but now his 2% floor limitation becomes $4,000, and his deduction is 0. Okay. Standard deduction, we already talked about this, so we don't need to talk about it anymore. I'll provide you the amounts of the standard deduction. Remember, you get a little bit extra if you're 65 or older and or you're blind. And we talked about the standard deduction and how it's limited for dependents. You should be comfortable with those rules. We discussed them in Chapter 4. The very last thing for Chapter 6 is high-income taxpayers are subject to a phase-out of itemized deductions and exemptions. There's good examples in Appendix A and Appendix B of Chapter 6. So what constitutes a high-income taxpayer? Here's the thresholds. These thresholds will not be provided. Well, I'll provide them on the exam. So I'll give you these thresholds for the exam. You just need to know what to do with them, okay? So basically, based on your filing status, if your AGI is higher than this threshold, then you don't get to deduct 100% of your itemized deductions, and you do not get to deduct 100% of your exemption deduction, okay? Both itemized deductions and your personal and dependency exemption deduction is limited or reduced if your AGI is in excess of these thresholds. So let's look at how we apply the phase out for itemized deductions. It's only certain some itemized deductions are not subject to the phase out. Do not worry about this for the exam. If this is on the exam, all of the expenses that I give you, you can assume that they're all subject to the phase out. But in reality, medical expenses, casualty losses, investment interest, and gambling losses, for some reason, aren't subject to the phase out. I really don't know why. Maybe people in Vegas have good lobbyists that are looking out for them. Okay, I'm not sure why. Gambling losses are not subject to the phase out. But again, if it's on the exam, you can assume that they're all subject to the phase out. Again, Appendix A has a good example if there are some phased out deductions, but let's look at my example, which is easier and the most you would need to know for the exam. So let's say we have a single taxpayer with an AGI of $320,000. That taxpayer's itemized deductions are $38,678. None are exempt from the phase out. So we go and we look at the phase out for single taxpayers. It begins at income or AGI of $254,200. Our taxpayer's AGI is in excess of that, so we know that his itemized deductions are going to be limited. The amount of the limit, okay, or the phase out amount, again, it's one of these lesser of situations. The amount that we have to reduce his itemized deductions by is the lesser of 3% of his excess AGI, okay, or 80% of his total itemized deductions. So let's look at how this works. So his excess AGI is his actual AGI minus the phase out. Okay, so his actual AGI was provided 320. Okay, and then the excess is dependent upon his personal phase out for his filing status. So the phase out for single taxpayers 254,200. So that's where those numbers are coming from. So we figure out how much is his AGI over the phase out for single taxpayers, and we take that excess amount times 3%. If we do that calculation for this taxpayer, the phase out amount would be $1,974. We also have to calculate 80% of his total itemized deductions, which would be $30,942. That's 80% times itemized deductions of $38,678. Okay, so that's where that number comes from, 80% of this number. and we take the lesser of those two amounts. Obviously, the first number is the lesser by far, so we have to reduce this taxpayer's itemized deductions by $1,974. Okay, so this the amount that we calculate is a reduction in deductible itemized deductions. So how much can this taxpayer deduct? We take his overall itemized deductions minus the phase out to come up with what's actually deductible. Okay, so this taxpayer, because he's high income, because his AGI is so high, he does not get to deduct all of his itemized deductions. His itemized deductions are limited. We talked about how we calculate the limitation, and so the amount that he can deduct is $36,704. Okay. Personal exemptions are also phased out. The phase out is a little bit different, but the thresholds are the same. Okay, so we still use these thresholds. These are the ones that matter to figure out if your exemption deduction is limited. Okay, so in this example, we have a taxpayer that's filing as head of household. Her AGI is $335,150, and she has 3 exemptions. So this must be one for herself, and then she has 2 dependents. So she gets 3 times the exemption amount, $3,950. So her deduction before limitation is $11,850, but because her AGI is so high, she can't deduct this entire amount. And we have to do the calculation to figure out how much can she actually deduct. Okay, so to calculate this, we start with her AGI and we subtract the threshold. So again, her AGI is $335,150. This threshold amount is the amount that I'll provide on the exam. For head of household, it's $279,650. Okay, that's the threshold amount. So we take her AGI minus the threshold to come up with $55,500. This is her excess AGI. We take her excess AGI and divide it by 2,500. Okay, you always divide the excess AGI by 2,500, and you'll get a number. The number we get for this taxpayer is 22.2. You always round up. Okay, it doesn't matter what this decimal is. If there's a decimal there, you round up to the next whole number. So for this taxpayer, we would round up to 23. So then we're going to take our answer to the second step, or 23, and we're going to multiply it by 2%. Okay, so take this answer times 2% to get 46%. Okay, so just keep the 2%. Don't turn it into a decimal. Just basically take the answer you get for step 2 and take it times 2, and then that's the percent reduction. Okay, so for this taxpayer, it's 46%. This is the amount of her overall exemption, the $11,850. The 46% is the amount that she has to reduce her deduction by. Okay, so the 46% is the non-deductible portion of her exemption deduction. Okay, so we take her total exemption, $11,850, because she has herself and she's claiming 2 dependents. So her unlimited deduction is $11,850. We take that times the percentage we just calculated, or 46%, and this tells us her non-deductible portion of her expenses. So the amount that she can deduct for her personal and dependency deduction is $6,399. Okay, so because her AGI is so high, she cannot deduct this entire amount. Because she's high income, we take some of that benefit away. The amount of the benefit that we take away is $5,451. Her deduction becomes $6,399. Okay, so that's the personal and dependency exemption phase out. So let's quickly go through what's important from the earlier chapters. Okay, very quick review of what's important, and I'll also highlight some things that aren't important. So from chapter 3. Chapter 3, we talked about some of it for exam 1. What we determined for exam 1, what we looked at were timing strategies when tax rates are constant. And what we decided before the first exam was that if you have a cash basis taxpayer and tax rates are constant, what we'd like to do at the end of the year is accelerate deductions and delay income recognition. So that was an exam 1 thing. That's what we decided for exam 1. So what we've added since then is what happens if you don't expect rates to be constant? What if you think rates are going to change? If you think your rate's going to decrease, if your rate this year is 30% and you think next year your rate is going to be 20%, decreasing tax rates just make this strategy up here even better. Okay, so if rates are decreasing, you want to do just what you would do up here. You would want to accelerate deductions. You would want to delay your income recognition. Okay, You would accelerate your deductions to deduct them when your tax rate is high, and delay income recognition so that you report the income when your tax rate is low. If you expect tax rates to increase, if your tax rate is currently 20% and you think it's going to be 30% next year, then these strategies might not make sense and you might actually want to do the opposite. You would still want to do a present value calculation, but probably you'd want to do the opposite, but you'd want to run the numbers to just confirm that that's correct. So if you think rates are going to increase, then you might want to accelerate your income to pay tax at the lower rate, and you might want to push your deductions into the future so that your tax savings is driven by that higher tax rate. Okay, so that's one thing that we added for Chapter 3 is just conceptually thinking about what happens if our tax rates change. There will not be a calculation problem for this, okay? You will not have to do a calculation. You just need to conceptually understand what makes sense if rates decrease, what makes sense if rates increase, okay? And then the next thing we talked about for Chapter 3 are income shifting strategies. So basically, there could be a benefit to shifting income. If it's income, we want to shift income to taxpayers paying a lower tax rate. And if we have deductions, we want to shift those deductions to taxpayers paying a higher tax rate. So that's what we want to do with income shifting. Deductions to high income taxpayers, income to low income taxpayers. Okay. We talked about two ways that we might want to shift income. The first way is among family members. So we talked about two ways for family members. The example that's in the problem set for Chapter 3 is if you have a sole proprietorship. One way you can shift income is by employing a child in your sole proprietorship. I would say that's more of a conceptual issue for Exam 2. I wouldn't worry about doing that actual calculation for the exam. So problem 11 in Chapter 3 goes through a calculation. I would not worry about that so much for Exam 2. I would worry that I understood conceptually why I'd want to shift the income and what the strategy might look like. Problems that I would study are problems 12 and 13 from Chapter 3. So these problems involve shifting income from an individual to a corporation. Okay, so really study problems 12 and 13. Make sure you understand those, and if you don't, stop by tomorrow. So there's three things I think you should be able to do with a problem similar to problem 12 and 13. The first thing that I would expect that you could do is tell me how much income should be reported by the corporation and how much should be paid in a salary and shifted to the individual taxpayer. So that's the first thing. How much income should be reported by the corporation, how much income should be reported by the taxpayer. So that's item 1. The second thing I would expect that you could do is to tell me the tax savings from implementing a plan like this. So if you look at the solution for the Chapter 3 problem set, I calculate the tax savings differently for problem 12 and problem 13. I think if you study or review the tax savings calculation for problem 13, it's going to make more sense. Basically, to calculate the tax savings, just figure out the total tax that the taxpayer would have to pay if he or she reported everything on her personal return, if everything was taxed using the individual rates. From that total amount, subtract the total tax if you do it this alternative way. Calculate the tax that the corporation would have to pay, calculate the new tax that the individual would have to pay, which would be the salary plus any other types of income. Calculate the tax on that, and then compare those numbers. Okay, so study problem 13, how to calculate tax savings, and hopefully that's more straightforward than how I did it for problem 12. But you should be able to calculate tax savings. Okay, from implementing a plan like that. And then finally, you should be able to tell me a couple of potential limitations to doing something like this. So the first potential limitation is any income that's going to sit in the corporation. Now there's money in the corporation, you're doing that so you can pay the lower corporate tax. But what you need to realize is once that income is in the corporation, the only way you can get it out is by paying a dividend, and you're going to have to pay tax on that dividend when you pull it out. Okay, so that's the first limitation. Corporations are subject to double taxation. If you want to get the money out of the corporation after the corporation's reported it and paid tax on it, you're going to get hit with another 15% tax. It's going to be a qualified dividend. You're going to have to pay tax on the money when you take it out. The second potential limitation are constructive dividend concerns. So this strategy involves incorporating and then the corporation paying a salary to the individual owner. The limitation that you run into here is the IRS might disagree with you what that salary number should be. If the IRS thinks that you've paid yourself too much in salary, then the difference between what you actually deducted and what the IRS thought you should deduct, you have to treat that amount as a dividend. So what that means is the difference between what you actually deducted and what the IRS thinks is reasonable, that's going to increase your corporate taxable income. And that increase in income is going to be taxed by the corporation, and it's probably going to be taxed at 34% if you look at the corporate tax tables. So for this strategy, we want to put money into the corporation, usually up to $75,000, okay, so that we can maximize income being taxed at the 15% rate and at the 25% rate. So if you look at the corporate tax table, typically what we're doing with this strategy is leaving $75,000 in the corporation and shifting everything else to the individual taxpayer. If you look at the corporate tax table, after the 25% bracket, the next bracket is 34%, which is probably much higher than what you pay as an individual taxpayer. So this constructive dividend is a concern because if the IRS comes in and says you've paid yourself too much in a salary, you need to go back and treat that like a dividend, you're going to get hit with a really hefty corporate tax, okay? You're going to have to pay a lot more in corporate tax, and the additional amount you have to pay in corporate tax might be more than what you would have had to have paid initially if you kept this thing as a sole proprietorship. Okay, so the second limitation are constructive dividend concerns. You should be aware of what a constructive dividend is, basically what it means, why it's bad, and why we would consider that a limitation to implementing a plan like this. Okay, so if you know this amount for Chapter 3, you will be fine. If you know those couple of conceptual type things, and if you can do a problem similar to 12 and 13 from Chapter 3, you will be fine, okay, for Chapter 3 for Exam 2. So very quickly, Chapter 4, let's just hit the highlights. Let's hit the things that might be difficult or confusing. So filing status. Married filing joint, usually it's pretty easy to determine if you can file a joint return. It's dependent upon your marital status on the last day of the year. So if you're married on December 31st, you can file a joint return. So something to remember about the married filing joint status is that this is your filing status in the year that your spouse dies. Okay, so your spouse dies. In the year of death, you can still file married filing joint. Okay, and in that year, you also get 2 personal exemptions, 2 times $3,950 in the year of death. The second filing status is a qualifying widow or the surviving spouse. Okay, those things are synonymous. They mean the same thing. So this is your filing status for the 2 years following the death of your spouse. So in the year of death, you're married filing joint. If you have dependent children, they have to be children. It cannot be your grandparent or your parent living with you. In order to use this status, it has to be a child. If you have a qualifying dependent child, then the year of death, you file married filing joint. And the next 2 years, if you don't remarry, you get to file as a qualifying widow or surviving spouse. So basically, for 3 years, you get the benefit of the best tax rates. First year, married filing joint, next 2 years, qualifying widow or widower. The next filing status is head of household. I think this is the trickiest of all of the filing statuses, okay? So head of household, things to think about. This is your filing status if you're not married, you're not a surviving spouse or qualifying widow. These are qualifications to file as head of household. Unmarried, you're not a surviving spouse. You have to pay for more than half the cost of maintaining a home. So you, the taxpayer, has to provide a home, and you have to cover half of the cost of that home. And then the second requirement is you have to have a qualifying person living with you in that home for more than half of the tax year. Okay, so there's a couple of exceptions to this qualifying person. If your qualifying person is a dependent parent, so if you can claim your parent as a dependent, you can file as head of household even if your parent does not live with you. Your parent could live in a nursing home, your parent could live in his or her own apartment, but you're covering all of the cost of that apartment. That's fine. You can still qualify as head of household. For any other qualifying person, that person actually has to live in your home. If it's a parent, you do not have to meet that requirement. You can still file head of household if your parent does not live with you. The second thing to be careful about with head of household is if you have a dependent that's a qualifying relative, but they're not related to you. Basically, if you have a dependent and the only reason they're a dependent is because they've lived in your house for the entire year, someone lives in your house for the entire year and you're providing all of their support, you can claim them as a dependent, as a qualifying relative. If this is your only dependent, is this qualifying relative because the person lived with you for the entire year and that person is not related to you, you can claim them as a dependent, but your filing status is single, okay? A person like this, a qualifying person like this, a relative that's only a relative because they live with you, does not qualify you to claim head of household status. So if this is your situation, you're single, you have one person living with you, they're a qualifying relative, you can claim them as a dependent. You might not be able to file head of household. Your status might be single with 2 exemptions. So I think those are the 2 tricky things with head of household, 2 things that you need to be aware of. So we did some problems about determining filing status in class. There was a bunch of homework problems. If you study those, if you can do the class problems and the homework problems in terms of filing status, you will be fine for the exam. Okay, there's going to be 5 questions asking you to determine a taxpayer's filing status. So a number of different scenarios, you're just going to have to tell me what the status is. Okay, practice the in-class problems, practice the homework problems. If you understand those, you should be fine. Okay. So the last 2 filing statuses, single is pretty self-explanatory, unmarried, no dependents, or your only dependent is a qualifying relative who lives with you for the entire year, then you're single. And then the last filing status is married filing separately. This is not a good status. You would only choose this if you had a compelling non-tax reason to do so. In terms of married filing separately, you might just give a review of the abandoned spouse rules. So if you're married and your spouse leaves you and you're stuck kind of taking care of the kids by yourself and covering the cost of your children and your spouse has moved out, you don't know where they are, you might qualify under the abandoned spouse rules. Okay, so take a look at those. Basically, the abandoned spouse rules allow you to file using head of household instead of married filing separately. Okay, technically, if you're still married, you should file a joint or separate married return. But if you're an abandoned spouse, then you can file as head of household instead of filing a separate return. So you might just review those rules and let me know if you have any questions. Okay, so I have the individual tax formula up here. Hopefully this is not surprising or new for you. I only put it up here because it is my a recommendation to you for the exam. If I were you, I would put this table on my cheat sheet and I would use it for almost every single problem. If I'm asked to calculate taxable income, if I'm asked to calculate taxable income and then income tax liability, I would start with this table, and this table is going to help you organize all of the information so you know where to include things and where to deduct things, okay? So this is just up here as a suggestion. Put this on your crib sheet, okay, because it could potentially be helpful. Hopefully for Chapter 4, if you didn't use this formula, if you go through the solution, I kind of put the solution based on using this formula, and hopefully, you know, if you review it, you might see that it could be helpful to use the formula on the exam. We talked about character of income in Chapter 4. So tax exempt, we'll talk about for Chapter 5. Don't worry about tax deferred income. There's not going to be any questions about tax deferred income on the exam. We'll talk about like-kind exchanges later. We'll talk about 401k plans later. It's not something that's going to show up on exam 2, so don't worry about tax deferrals. So maybe what you need to know for character of income is just that most income is ordinary, and ordinary income is subject to your marginal tax rates. 2 exceptions are qualified dividends and capital gains. This type of income is subject to a 15% for most taxpayers, except 20% if you're in the highest marginal tax bracket, and 0% if your marginal rate is 10% or 15%. So we talked about these things in class, but for most taxpayers, if they have qualified dividends, they only pay a 15% rate on that income, and capital gains, if they're long-term, you're only paying a 15% rate on capital gain income, okay? So I have this on here, these rules for deducting capital losses. Don't worry about this for the exam, okay? I don't think there's any place on the exam where you need to worry about whether or not you can deduct a capital loss. So don't worry about it. We'll hit this, I think, in one of the later chapters, we'll talk about investment income, and we'll hit this topic in more detail. And so this will be a exam 3 thing to worry about. Don't worry about it for exam 2, okay? But just generally know that long-term capital gains and qualified dividends are subject to a preferred rate. Usually that rate is 15%, okay? Don't worry for this exam about the limitations on capital losses. Finally, for Chapter 4 are dependency requirements. So if you can claim someone as a dependent either as a qualifying child or as a qualifying relative. If I were you, I would put these rules on my crib sheet. There's going to be 5 questions asking you to tell me if someone can be claimed as a qualifying child or as a qualifying relative or neither. Okay, so you're going to have to either say qualifying child, qualifying relative, or tell me neither. So you need to understand the rules. Okay. So I think this is pretty straightforward. To claim someone as a child, they have to meet a relationship test. Kids, grandkids, adopted kids, stepkids, they all count. Brothers and sisters, if they're younger than you, count. Nieces and nephews count. Okay, so these are the relationships that will qualify someone as a qualifying child. The age test, under 19 or under 24 if you're a full-time student. Remember that in order to be a full-time student, you have to be a full-time student for 5 months of the tax year. 5 months is what deems you a full-time student for the tax code. The residence test means that you have to live with the taxpayer for more than half of the year. Short-term absences for school, if you live here in the dorms or off-campus housing, your parents can still claim you because your primary residence is with them. You're still going home over the summers and for school breaks, and so you would still meet the residence test. The last test is a support test. Remember that to claim someone as a child, the way we interpret the support test is that the child cannot provide more than half of his or her own support. So to claim someone as a child, you do not have to provide half of the support yourself. They cannot provide half of their own support. So that's how we interpret the support test for a qualifying child. You might take a quick review of the scholarship rules. So if a parent is claiming a child as a dependent, we ignore scholarships. If anyone else is trying to claim that person as a dependent, like a grandparent or an aunt and uncle, then we have to include any scholarships received into the support calculation, okay? Then any scholarships, if it's not a parent claiming the child, any scholarships that the child receives would count towards them providing their own support, okay? So we talked about this. I think we went over an example, an in-class example about this. I would review those rules if I were you. You might give a quick review of the tie-breaking rules. So what happens if more than one taxpayer can claim someone as a dependent? So the tie-breaking rules, generally, parents have priority. So if you have kind of a multi-generational home, grandparents, parents, and kids all live in the same house, maybe the parents and the grandparents could claim that child as a dependent. The parent always has priority over anybody else. If 2 parents can claim the child, so maybe parents got divorced late in the year and both parents can claim that child, who gets the exemption? The exemption is going to go to the parent with whom the child lives with the most, okay? So if the kid is spending weeks with mom and weekends with dad, mom gets the exemption because the child is with mom more, okay? So that's the tie-breaking rule. If both mom and dad can claim the child, it's where the child lives most of the time. If the child lives equally with both parents, okay, 50-50, then the deduction goes to the parent with the highest AGI. So those were the rules for qualifying children. The rules for qualifying relative, there's still a relationship test. We open up the relationships, so we include more relationships than we do for a child. We also include unrelated people. Anybody that's unrelated to us, if we'd like to claim them, they have to live with us for the entire year. If someone's related to us, then they don't have to live with us for the entire year, okay? So that residence test only applies if they're unrelated. So if your buddy's living in your basement, to claim your buddy as a dependent, he or she has to live there for the entire taxable year. If your uncle, if you're supporting your uncle and you want to claim your uncle as a dependent, your uncle could potentially be a qualifying relative even if he doesn't live with you, okay? So that's one thing with the qualifying relative. Make sure you understand that relationship test. The support test for a relative says that the taxpayer actually has to provide half of the support in order to claim someone as a dependent. And finally, the gross income test. The person you're trying to claim as a dependent, their gross income has to be less than the personal exemption amount, or less than $3,950 for this year. Okay, so that's chapter 4. I think the big things for chapter 4 really are understanding filing status and understanding whether you can claim someone as a dependent, and understanding kind of the small nuances that are associated with both of those topics. So chapter 5, gross income, we'll go through it pretty quickly. So some of the big topics from chapter 5. Remember that realized income does not always equal recognized income. Recognized income is income that we have to report on our tax return. Remember that we do not pay tax on stock appreciation until we sell the stock. Recall the return of capital principle. If we sell something, we get to deduct our basis before we figure out our taxable income. If we sell something, the amount that's taxable is the amount that we receive minus any selling expenses minus our basis, and that becomes our taxable income. So kind of be aware of that return of capital principle. Make sure you understand the tax benefit rule. So this was a homework assignment or a homework problem in chapter 5. As I was reviewing that homework, many of you got it right, so I think most of you understand the tax benefit rule. This usually applies to state income tax refunds. Remember, a refund is never taxable if you took the standard deduction last year. So whether or not the refund is taxable depends on whether you took the standard deduction or the itemized deduction last year. If you took the standard deduction, your refund is never taxable. If you itemized last year, then the amount of your refund that has to be included in income is going to be the lesser of the actual amount of the refund or your itemized deductions minus your standard deduction in the previous year. So you're gonna take the refund, you're gonna you're gonna take itemized deductions minus standard deduction last year. The lower of those two amounts is the amount that you have to include in taxable income if you get an income tax refund from a state. Okay. So just very quickly, I think chapter 5 is kind of long, but we can boil it down to just make sure you understand what income is taxable and what income is not taxable. Okay, so here's a laundry list of items that are taxable. So any income you receive from providing services, wages, salary, self-employment income, that's always taxable. Also, unemployment benefits, those are always taxable. Okay, typically this income is taxed at your marginal tax rate. Okay, but if you work and you get paid for the work that you do, it's taxable income. Income that you receive from property, this is basically investment income. So it's interest income, dividend income, capital gains and losses, rental income, royalty income. This income is all taxable too, okay, typically. One exception is municipal bond interest, but any other interest, dividends, rent income, royalty income, annuity income, all of these things are taxable income, okay? Just recall from the previous chapter that qualified dividends and long-term capital gains are taxed at that nice rate. Everything else is taxed at your marginal tax rate. Other income that you have to pay tax on, annuities, income from pass-through entities. Don't worry too much about this one, okay? We'll talk about this till you want to scream next semester. We'll talk all about pass-through entities and how we treat the income coming out of there. Don't worry about it for exam 2. Alimony is taxable income. Most prizes and awards, you have to include that as taxable income. Gambling winnings, Social Security benefits, discharge of indebtedness. This is kind of the laundry list of items that you have to think about including in taxable income. Okay, some of them require an additional calculation, but if you see these things, your gut reaction should be, well, at least some of it is included in taxable income. Okay. So some special cases, so things to think about when you're trying to figure out how much is taxable. For annuities, remember that we have to figure out that ratio where we put the amount of our basis in the numerator, the expected value in the denominator. That provides a percentage. That percentage is the non-taxable portion of our annuity, the amount of the annuity we receive. That percentage tells us what's not taxable. The remaining is taxable. So if you receive annuity income, you have to do a calculation to figure out how much is taxable. Prizes and awards. So this was kind of a common mistake in the Chapter 5 homework that I looked at. So some people wanted to make like the award that the taxpayer won for writing an essay or something. You wanted to say that that was tax exempt, but it wasn't. So most of the time, all prizes, all awards that you receive, you have to include it in taxable income. The two very narrow exceptions are something like a Nobel Prize if you donate all of the proceeds to charity. So that's one very narrow exception. The second very narrow exception are if are employment related. So your employer gives you a very small non-cash prize, less than $400, okay, not cash. You do not have to include that in taxable income. Those are the only two exceptions though. Every other prize, every other award, you have to include it as taxable income. Social Security benefits, so I'm sorry, you just have to practice those formulas until you get it right every time because you will see that on the exam. I'll give you the formulas, but make sure you know how to use them. If you don't, stop by tomorrow and I can help you out. And then the last thing that it's kind of a special case is discharge of indebtedness. Usually if someone cancels a debt for you, that's taxable income for you, except that it's not taxable income if the taxpayer is insolvent both before and after the discharge. So this is giving a break to people who are in really bad financial situations, okay? So review your notes on discharge of indebtedness because there will be a problem like that on the exam, okay? So things that are not taxable, so municipal interest, state and local bond interest, not taxable. Make sure you review the rules for if you sell your personal residence. If you're married, you can exclude up to $500,000 of your gain. If you're unmarried, you can exclude up to $250,000 of your gain. Again, the first thing that you do is you take the amount that you sold it for minus your basis, and this establishes your gain, okay? Then if you're married and you meet the requirements, if that gain is less than $500,000, you report no taxable income. Okay, your taxable income is only the gain in excess of the exclusion amount. The exclusion is $500,000 if you're married, $250,000 if you're unmarried. The test that you have to meet is an ownership and a use test. This just says that you need to own and have used the house as your primary residence in any 2 of the last 5 years. It does not have to be the most recent 2 years, and the 2 years does not have to be consecutive. You can live in the house for a year, rent it for 4 years, move back in for a year, and then sell it. You've still met the 2 out of the last 5 years requirement. Okay, so I think there was some kind of question about that on the homework. You should understand those rules for the exam. So it's 2 out of 5 of the last 5 previous years. Other non-taxable income, fringe benefits. Don't worry about this for the exam, okay? We'll talk about fringe benefits for the final exam. We'll talk about it in more detail in a later chapter. But basically, fringe benefits are non-cash compensation, and you don't have to report the value of this as taxable income. Scholarships, as long as you're using the money to pay your tuition, fees, supplies, and books, is non-taxable. If you get so much scholarship money that you pay for all of those things and then you buy a car with your excess scholarship money, then that excess scholarship is going to be taxable. Gifts, inheritance, and most life insurance proceeds, not taxable income. Don't worry about this too much for the exam either. Okay, we have a whole chapter that talks about transfer taxes. I don't think there's really anything on the, well, maybe there is one thing on the exam, but it's just very general. So in general, if you receive a gift, if you receive an inheritance, if you are the beneficiary of a family member's life insurance policy, and you get income from these items, you do not have to report any of that income as taxable income. You don't pay tax on any of it. And finally, workers' compensation, not taxable. Okay, so a couple of special cases. Sometimes this stuff is taxable, sometimes it's not. The first is settlements from a lawsuit. So if you sue someone and you receive a settlement and the settlement is for physical injury, generally it's not taxable. If it's for anything else, like defamation of character or something, then it is taxable. Okay, so the determination is whether or not you've incurred a physical injury and the payments are for that injury. Okay, injury related, generally non-taxable. Non-injury related, generally taxable. Punitive damages are always fully taxable. Okay, and then finally we have disability insurance, and we talked about this a little bit today in class. I don't think you have to worry about this too much for the exam. Okay, yeah, I don't think you need to worry about it at all, actually. But if you get paid out an amount from a disability insurance policy, the proceeds, whether or not they're taxable, depends on who pays the premiums. If the taxpayer pays for the premiums, not taxable income, then the proceeds are not taxable income. If the employer pays for the policy and it's a non-tax fringe benefit, okay, then the proceeds are included in taxable income. If the employer pays for it and it's treated as compensation and the taxpayer has to include the value of those premiums as income, then it's as if the taxpayer has paid the premiums himself or herself, and again, that would cause the proceeds to be non-taxable. So the taxability of disability insurance proceeds depends on who pays the premiums. If the taxpayer pays the premiums or includes the premiums as taxable income, then the proceeds are non-taxable. If the taxpayer's employer pays for the premiums and treats that as a non-taxable fringe benefit, the employee never pays any tax on the value of those premiums. Then if the taxpayer receives proceeds from the policy, those proceeds are fully taxable, okay? All right, finally, chapter 6. So we talked about most of this stuff pretty recently, so we can go through it very quickly. So chapter 6, deductions. Generally, we have to determine if our deductions are above the line or for AGI deductions, or if they're below the line or from AGI deductions. So first, let's quickly go over above the line deductions. So these are deductions that are all above the line. Any deductions that you report on Schedule C, any of your business-related deductions, those reduce your Schedule C income. You deduct those as above the line. Any deductions related to rental income or royalty income, you're deducting those on Schedule E. Those are above the line deductions. $3,000 of your net capital loss, again, don't worry about that too much, but that would be an above the line deduction. Any losses that you're reporting from a partnership or an LLC, again, don't worry about that too much, but those would also be above the line, okay? These are all things you get to deduct before arriving at your AGI. These are the ones that you need to be a little bit more concerned about. Make sure you review the rules for moving expenses. So you can only deduct unreimbursed expenses. You have to meet the time and distance tests. Remember, you never get a deduction for meals, you never get a deduction for house hunting trips, and you don't get to deduct the cost of temporary lodging. We talked about health insurance premiums today. If you're self-employed, you can deduct the cost of those premiums as an above-the-line deduction. If you're employed, then you have to take them as an itemized deduction. If you're self-employed, half of your self-employment taxes is an above-the-line deduction. Don't worry about that one too much. You're not going to have to calculate it. I don't think you have to worry about that one at all, actually, okay? So in the back of your mind, just recall that that's above the line, but don't worry about it too much. Similarly, with the penalty for early withdrawal of savings, we talked about that during class, but it's not something I would worry about for the exam. Alimony paid, that's something you might make sure that you know is an above-the-line deduction. Sometimes contributions to an IRA account, if they're deductible, they're going to be deductible as an above-the-line deduction. Of this list, the ones that I would worry about, the ones that I would make sure I understood, are moving expenses, alimony paid, and then the student loan interest and the tuition expense deductions, okay? So we just went over that on Thursday. I'll give you the tables of how you calculate the deductible portion of student loan interest, the deductible portion of tuition expenses. I'll give you those tables, but make sure you understand how to use them. We did some in-class problems. There was a homework problem, I think, that addressed that. That will be on the exam. Make sure you understand how to do that, okay? So again, ones you should focus on: moving expenses, alimony, student loan interest, and tuition expenses. Okay, and then this is what we talked about today. Okay, so these are just very quick. Here, I think on this slide, I just tried to help you recall whether your itemized deductions are limited and how they're limited. Okay, so understand medical expenses. The limitation applied to medical expenses is an AGI limitation. 10% if you're under 65, 7.5% if you're 65 or older. Okay, so that's a limitation that's applied to medical expenses based on your AGI. Make sure you understand the rules for taxes. We talked about that this morning. There's no limitation for taxes. Okay, any amount that you pay in taxes, if it's deductible, it's fully deductible as an itemized deduction. We talked about interest. Interest is subject to a limitation, but it is not an AGI limitation. If our interest expense deduction is limited, it's limited because of the amount of debt we're carrying, okay? So we talked about this. The limit for acquisition debt is $1 million. The limit for home equity loan is typically $100,000, okay? Or the fair market value of the property minus your acquisition debt. So interest can be limited, but it's not limited by AGI. It's limited by the amount of debt you're carrying. Charitable donations, that's where we started this whole long presentation, but charitable donations can be limited. If they're limited by AGI. Casualty and theft losses, they're limited by $100 and then by AGI. Make sure you understand or kind of write down on your crib sheet which itemized deductions, miscellaneous itemized deductions, are subject to the 2% limitation and which ones are not. All of them are, except for gambling losses and except for investment-related casualty losses. Investment-related casualty losses will not be on the exam, and I don't think gambling losses are on there. I don't think. So basically, any miscellaneous itemized deductions, if you have a question, how much can you deduct? Add them all together, subtract 2% of your AGI, and the deduction is going to be that excess. Okay. Definitely don't worry about investment casualty losses, and I don't know 100%, but I don't think that gambling losses are on there. Okay. But if they are, there's no AGI limitation. And then overall phase outs, we already talked about that. Okay, they're based on AGI. If your AGI is too high, then your itemized deductions can be reduced, your exemptions can be reduced. Standard deduction. So finally, so if someone can claim you as a dependent, your deduction for your standard deduction is going to be limited. It's limited to the greater of $1,000 or earned income plus $350. Please remember that earned income is wage income or salary income. It is not investment income. So we went over a couple of examples in class. There were also in-class examples, and I would review those. So I think there was an in-class example that looked at calculating a standard deduction for a dependent and then calculating that taxpayer's taxable income. I think I emailed everybody the solution to those in-class problems, but I would review that if I were you. Okay, so if someone's a dependent, make sure you can calculate their standard deduction. Then also make sure that you can use that tax formula to tell me what their taxable income is. Okay, so basically you're just going to pop in the standard deduction, and remember, if they're a dependent of someone else, then they get zero personal exemption. Okay, so those are the things you need to remember when you calculate their taxable income. But review that in-class problem. If you have any questions, stop by. So I apologize, super long, but hopefully now we're all clear with Chapter 6. Hopefully you feel better about charitable donations than you did after class this morning, and hopefully kind of the brief overview of everything else, highlighting what you should worry about, maybe more importantly, highlighting what you shouldn't worry about. Hopefully you found that to be helpful. Again, please don't be shy. Any questions, stop by tomorrow. If I don't see you tomorrow, I'll see you on Thursday. Study hard, good luck, and I'll see you on Thursday.